Alright, welcome to Situational Theory by dumbo. Um, this is just going to be a series based off ICT concepts and my personal understanding of the market and, things I think I could give to you that could be helpful and hopefully, if you learn something, you learn something. So before I start, I just want to give a huge shout out to my mentor because I think if it wasn't for him, I'd be very confused on a lot of the shit that I study now. Um, he taught me some stuff that helped me just you know open my eyes a little bit and you know has helped me use my brain like a lot more than I used to, which has helped me. So I just want to give a huge shout out to him, and let's get into it. So, the whole idea behind situational theory is to explain why everything is the way it is and why it's that way. And the reason why I think I could call it this is because everything, in trading, at least I'm an ICT trader, so everything that I understand and everything that you know, am learning and I'm using is very dependent of price and time, and it's very dependent of what has happened. So everything in the market is situational based off time and price, meaning days of the week, seasonal tendencies, macro times, session times. Price is purely dependent off of time. So, we have different type of price action every single day of the week. Obviously not Saturday or Sunday because market's closed, but price action on Monday is going to be different from price action on Friday. Price action on Wednesday is going to be different from price action on Thursday. Those are things that can account for how price moves and how price can be managed, right? Where price might even run to. Friday, such as TGIF, if you have a very bearish or bullish week, Friday is going to have a huge, a good reversal for 30 to 20 to 30% of the weekly range. Wednesday is typically a very high volatile day just because that's a lot of the days when high impact news comes out. Same for Tuesday, same for Thursday. Thursday can be high volatility because most Thursdays make a new high or new low on the week. You know, Seasonal tendencies. Price action during spring is going to be slower than price action during fall. Price action during winter is going to be slower than price action during June. Like I'm just giving examples, but it's things to account for. The other thing is session times. Price action during Asia session is going to be a lot slower than price action during New York. Price action during London session might be a lot more volatile and a lot more violent than Asia session. There's a lot of things to account for, and then such things as macro times. Macro times have setups and formations that you can look for within those times. Um, you know, so the first thing I'm going to start off with is market paradigm. So liquidity. Liquidity is what runs the market. It is basically the fuel used between buyers and sellers, which then creates the market to move up and down and become volatile. And volatile is meaning a lot of liquidity. So every time someone is buying or selling, that is injecting liquidity into the market. When there's a large magnitude of buying and selling all at one time, that creates volatility in the market. Now, where does liquidity lay? Liquidity is found above highs and below lows. How to know what liquidity has higher probability of being taken? Such things as when there is liquidity, stacked liquidity lying upon the same level or area, when lying in areas of the market that is unbalanced, when lying below slash above an inefficiency, or session highs and session lows. So if we were to look at the chart right now, such thing as you can see like right here, you can see that the market had a very violent drop, right here. So what does that mean? That means that the market is going to have to look to rebalance that eventually, right? It could go lower, but no matter how low it goes, the market will have to at least come up into 50% of this entire drop, right? So that means we can find a high probability liquidity to be taken. So if we were to go into replay and let's just say we have this, right? This drop has just happened. where does liquidity lie? It lies above highs and below lows. Well, if we're looking for the market to go up, we would be targeting highs, right? So within this huge drop right here, we can look for this high right here. Let me do this. We can look for this high right here to be taken. That's a high probability, liquidity level. We can look for this high right here to be taken. That's a high probability liquidity level. So as price moves on, you can see that eventually this whole range, this whole drop is going to be rebalanced, and both of these are going to get taken. As you can see, it just runs right through it. Okay, well, let's look at this, right? We can even take, which if you don't know already, you'll learn this in either this video or the next video. So you have a range which market will have to rebalance at least 50%. So when you have liquidity that lies below 50% in a bearish market, well, that's a high probability liquidity level to be taken. So we can see the 50% line is right here of this, range of the drop. So has this price point from this low that we created, has this price point of this high touched or even gotten up to 50%? Absolutely not. So any price point that we have that has not pierced 50% is going to be high probability liquidity. So it might take time because again, it is, again with session times, right? This whole area right here is London and Asia. So it's going to be a lot slower to get to that. But you can see in New York Asia time, we do get to that, right? So it's always, there's a lot of things that are based off time. And that's one of them. You can see that we eventually do rebalance this whole range, right? Now it's rebalanced. And 50% is always going to be what is considered rebalanced of, anything, which I'll get more in depth into that when I talk about ranges and price structure. I don't know if it'll be this video, but it might be the next video. But yeah, let's look for another example. Let's see. Even here, right? So the market, again, the market had a drop, a very violent drop, right? A very fast drop without leaving very much liquidity. So you can see within this, the market will have to rebalance from this high to this low, right? So we can see that if we were to take that from this high to this low, or just, somewhere about that, we can see that this liquidity has not pierced 50%, right? So this can be a high target probability of liquidity. So if you're looking for longs, let's say you entered, wherever it is, you can target this high for liquidity, and then the next target can just be 50%, right? You're always wanting to target, high probability liquidity. Again, like with this, you have this very strong pump. Market's going to want to rebalance that. You can see that all of this liquidity, it's all stacked in one area, right? These lows, this low, this low. It's all just stacked here. And what do? The market violently takes it out, which is what it should do, because it's going to take that out to violently rebalance this so it can keep moving either up or back down, right? We can even look at, a higher time frame to look at things. Let's see. Alright, so we'll just go over here. Even with like this, right? You can see that we have this very violent drop. Very, very violent drop, right? Now, if market was to look to rebalance, well, you can see it did it quite fast. But you can see also in hindsight that if market is going to, continue going up, which as it should, what do we have right here? You have stacked liquidity. You have stacked liquidity up here. So therefore, you can see, oh, even here, look. We stacked more liquidity, and then what did it do? It ran right through it, very, very violently right here, right? So it's always going to be high probability liquidity when liquidity lies in unbalanced price ranges. Sorry to abruptly cut the video. I just wanted to give some more examples for people that are just now getting into this or new to learning, kind of help you envision things and see things a little bit more. So I thought I'd kind of go over each one. So the first point that I had to which liquidity has high probability was stacked liquidity, and the example that I gave was right here. All this stacked highs, right? So another example could be something like this, where you have a lot of highs in the same area, and it'll be, the more you start looking at charts, it'll be a lot easier to see the more you look at it. So you can see here, all these highs are kind of like just in the same area. Now, obviously, we're not going to count points and say, oh, well, it's in a 30-point range, but it's just kind of noticeable And again, you have to do your own studying for this to kind of see things a little bit more, but this is a good example, and you can see with all this stacked liquidity here, and then you can even pair it with this further over here. You can see the market violently ran through that. We can even scale down onto like a 1 minute time frame and go to like, we'll go aside from this week because this week was bad price action. But even here is a good example. So right here you can see that we have these highs, and I'll even like mark it with this. We have all these highs like kind of like in the same area, right? So this one kind of counts because it's like really close, and then even this one it pairs like right with it, right? And then what you can see, we just ran right through it. So there's another example. And even for lows, you can see that all these lows right here, this one, this one, this one, they're all kind of in the same area. And then what did we do? The market just violently ran through that. Another good note that you could add to your notes is smooth edges will always be ran through by jagged edges. So meaning that stacked liquidity in the same area is counts as smooth edges, whether it's lows paired, whether it's highs paired like this, all these highs just in one area, that's all smooth. And what did we do? We disrupted it very jaggedly. And it doesn't necessarily mean that there's going to be a reversal there. You have to, I'll get into this in, more videos, more advanced concepts that you'll learn of how to use all this together, but just, to kind of get your brain working and understanding of how the market moves is uh, it's important and it's good to know. So again, like all these stacked liquidity here, you can see we just ran right through it. Let's see. I guess we haven't came back down here yet. But I mean, there's a ton of examples, and the more you look at charts, you'll just see like it gets very obvious to some points. Like even with this, right? And it's a very easy thing to see in hindsight. Sorry for the coughing, but you can see like all these lows right here, right? They're all in one area, and what do? We very disruptly, corrected that. We jaggedly did that, right? All these smooth edges get corrected by jagged edges. It's something that ICT says, and I think it's something good to keep note of. Even with this, like this is a good example. Stacked highs right here just ran through, very jagged. And there are times where, like, even if you're in a market like right here, and you see this, and you could think, well, okay, well, it could get corrected. But the more highs that you build in one area, or the more lows you build in one area, just creates a higher probability for it to get taken. So even with this, right, all like you can just honestly you could count all this as like stacked highs, right? It's just building up more and more, and it doesn't matter if it goes lower because the market's gonna come back up here. It doesn't matter if it came all the way down here. It doesn't matter because at some point it's going to come back through this and very jaggedly disturb it. Um, More of so highs than lows, and again you'll kind of learn how to use these later in the future. But I wanted to go over examples with that. Oh my gosh, if I could stop coughing. Um, and then when lying in areas of the market that is unbalanced. Now, if you are new to trading, don't stress about a range yet. I will get into that in the next video. And it's good to just kind of tell you this because then you'll be able to start noticing things. If you when you do your own studying or when you're watching more videos, you may not understand, and that's okay. But it's also good to at least see things because then I think, at least for me, the more you start seeing things, the more of a pattern it'll create in your head. So I was going over this example with, how the market needs to rebalance. And when there is liquidity lying in a bearish market below 50% or in a bullish market above 50%, that liquidity is very high probability. And we'll go to a bullish example. We've been in a bearish market for quite a while, but we could even go like here, like this. This is a good example. You can, and again, like this is a great example because it doesn't matter how much higher the market's going to run. Um, it eventually has to, come back down and correct. Oh, it's actually a bad example. Sorry. Let me see. Okay, this is a good example. So right here, you can see that the market had a very strong run up, right? Without this from here all the way up, right? So you can just take the range of that, and you can see that liquidity is in 50%, right? So this liquidity, and remember, liquidity lies below lows and above highs. So it's never just going to be, all of this, which this can count, but this is still a very high probability liquidity. So you use high probability liquidity to use as targets, meaning if you're in a short position, because you're looking for the market to come down, you can target this along with 50% of that range. So, and even here is a good example. You can see that we have this stacked liquidity right here, right? This low and this low, right in this exact same area. And then what did we do? We disturbed it by a very jagged edge. That's a very great example for that. Um, and again, you'll learn a lot more, and you'll be able to see this for yourself, even like here, right? So you have this run up from this low to this high. So where do we see liquidity that could look to be taken before it actually got to 50%? Well, this low, all of these lows, right? They're all high probability liquidity. And again, it doesn't mean that, right when you start getting that reversal, it's going to come down immediately. It can run higher and then come down later. And I think that's an important thing to know because you shouldn't be chasing, just kind of wait for a good setup, and if it doesn't work, then be patient, and if it stops you out or something, just have patience. When lying below and above inefficiency. So we can see, right, again with this example, this is a whole 4-hour inefficiency, and the next part that I'm going to teach you is inefficiencies. But you can see that all of this right here is liquidity, right? All of this is liquidity, and we could even take this high, right? So you can see we had this high before we came down a little bit more down here, so that's a high probability target. Now it's a lot easier to see probably on a smaller time frame. Yeah, so you can see right here, this high right here, and all of these highs are high probability because this line right here represents 50% of that inefficiency. So 50% is the rebalance target in a way. So everything, in order for it to be rebalanced, has to touch 50%. If it hasn't touched 50%, then it's unbalanced. And you'll learn that not everything has to exactly go to 50%, and this is why I think like everything is situational. It's a good example to bring up of how everything really is situational based off time and price. But you can see we haven't got to 50% with this high and these highs, so these are high probability targets. So we could say, you had this high and it came down, so you entered a long position. You could target this high and then, go break even or something, and then, target 50% or even higher if you have a better target in mind. And we'll go over a lot more examples throughout these videos. But, just kind of basic stuff to know and understand, which is a good concept and good things to learn. And then the other thing is session highs and session lows. Now, me personally, I don't really use these, but I know a lot of people do, and they are good. But this also has to go with time and price. So we can just go here, for example. New York Open is this 9 o'clock candle. So London low is this 4 o'clock candle. Now back to the time thing. Let me see if I can pull it up. This right here. London session is 2 to 5, right? So 2 a.m. to 5 a.m. in the morning. So you can see this hourly candle was created at 4, so this is London low because it was the low within that time period. And if you are in a short bias before market open, well then you could look to target that. Or even if you're up before, you could look to target that. This is just a good example. Even Asia high, you can see Asia high is basically when the market opens at, 6 to basically midnight if you want to do that. This isn't too bad. Or London session. So Asia high was literally right when it opened. The first hourly candle of Asia. That's Asia high. You can see the market aimed for that. So they are pretty much used almost every day. I just don't really use them as much. I don't really find them as helpful, but if you find something to where those are helpful, then you should use them. And yeah. The next thing is inefficiencies. Now, inefficiencies are gaps left when the market is running for liquidity. They can be known as liquidity void, an imbalance, fair value gap known as FVG, BISI, which is buy side imbalance, sell side inefficiency, or SIBI, sell side imbalance, buy side inefficiency, volume imbalance. Again, if you don't know what these are, I will be going over them in a future video. So please don't worry. Don't worry about getting your head wrapped around them if you don't know what they are. It's okay. Now, inefficiencies are unbalanced areas of the market. Now, remember what I was saying with the liquidity part, right? How to target high probability liquidity. Well, inefficiencies are where the market is unbalanced, right? So there can be something else that you can target within liquidity. Now, the market always needs to be rebalanced, and when it's not, it will make violent moves to rebalance. Remember? Now, look, you can see that even with this example, what did we create? Liquidity right here at this high, right? But it's not rebalanced, right? If we were to take this, I don't think, let's make sure I'm right. I hope I'm right about this, so I don't look like a fool. Yeah, okay, good. So you can see that within this drop, this is a high probability liquidity target, right? Because the market has yet to rebalance up to this 50% level. And what else do we have in here? Well, let's look at a higher time frame, right? Well, this is that same liquidity area. Now, again, I'll go over this in a future video, but this whole gap right here is known as an inefficiency. So then you can look for the market to, kind of rail through this, take this out very violently, which it did it not? It took it out very, very violently. That's a very violent move, right? And you can tell because price moves a lot faster. You can see this is very choppy, chop, 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 chop. This is a lot faster of price, right? This is a lot faster movement for price to move. Alright, I thought I should add on to inefficiencies, because I don't think I really went in depth about how they should be looked at. So you'll see them everywhere, and again, this is just to get concepts down. We're not learning how to use them yet or anything, but just to kind of get concepts down and understanding of what they look like. So right here is a great example of an inefficiency. You can see that the market created a big gap between candle number 1 and candle number 3. So we can even let me mark these real quick. Candle number 1 is right here. I'll make this white. 16. Oh, whoops. Make it like a large. Okay. Candle number 1 is this candle right here, right? Candle number 2. Oh, whoops. Candle number 2 is the candle that creates basically the big gap, right? And you can see this here, you can see this here, you can see this here, you can see it here, there's a gap there, you can see it here, there's a gap there. It doesn't matter if it's big or small, as long as there is a gap in between the candles without any overlapping wicks. And I would hope you understand what wicks are. If you don't, then please go find another video to watch and then come back to this one. So, right, you have this wick and you have this bottom wick, and in between that is a gap between the market. Now that creates your inefficiency. You can call this a fair value gap, or in a bearish market like we are right now, this would be considered a SIBI, sell side imbalance, buy side inefficiency. So you would mark it from the bottom of this candle number 1 wick to the top of candle number 3 wick. And I forgot to mark candle number 3, whoops. Oopsies. And candle number 3 is this one. Candle number 3. Candle number 3 is this one right here. So candle number 1, candle number 2, and candle number 3. So the candle that creates, which always should be candle number 2, the candle that creates the gap between both candle 1 and 3 is your inefficiency. And how to know it's an inefficiency as well is to see that there are no overlapping wicks in between, right? So you can see right here that candle number 1, candle number 2, and candle number 3, within candle number 2 there is a huge gap between candle number 1 and candle number 3. That creates your inefficiency. Now if we look at this, right, we have candle number 1 right here, candle number 2 that creates a gap, but candle number 3 encloses that gap with this wick. That is no longer your inefficiency because price basically disclosed all that price, all that area for it to possibly become inefficient. And remember, like how I was talking about earlier with liquidity, when something needs rebalanced, it always is rebalanced at 50%, right? So if we look at just this candle's range from high to low, You can see 50% is right there, so that's already rebalanced. Therefore, there's no need to use that. But if we use this candle, right? If we use this candle range, candle number 2 in the example that I'm using, where's 50% about? It's about right here. And even if we took from, even like this, how we should mark it, right? 50% is right there, and the market eventually rebalances it. But in the meantime, it's not rebalanced. Therefore, it's an inefficiency that is looking to be rebalanced. I think that's the best way I could put that. I just want to add that in there. And go on your charts. Look for examples. Like I can see 10 million of them. There's one right here. 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 It's very tiny, right? There's one right here, rebalanced right there, and look, market goes higher. Just you don't need to understand how to use them yet. Just start getting the concept down so you can start looking at them and seeing them a lot easier. Yeah.